Something happened on the night of January 30th, 2026 that you were never supposed to find out about. Not because it was hidden in some back room, not because it happened in secret, but because the financial media, the analysts, the talking heads on television, they simply chose not to tell you. A market that millions of ordinary Americans hold in their retirement accounts, in their savings, and in their physical vaults at home was taken apart piece by piece in under 60 minutes. And the safety systems that were supposed to stop it, they were never going to fire. Because the people who designed those safety systems made sure of that a long time ago. You are about to understand how the silver market actually works. Not how it is explained in textbooks, not how the exchanges describe it to regulators, how it actually, mechanically, deliberately operates in the real world. And once you see it, you cannot unsee it. Every suspicious price crash you have ever watched in this market will suddenly make complete sense in a way it never did before. If you have been following silver for any length of time, you already know something feels wrong about how it trades. You have probably watched the price spike and then get slammed right back down. You have probably scratched your head wondering why the worst moves happen exactly when physical demand seems strongest. You have probably told yourself it is just volatility, just the market being the market. After today, you will know it is something far more deliberate than that. Make sure you subscribe to Element Axis right now and turn on notifications, because what is developing in silver is not a one-time event. It is moving faster than almost anything else in the financial world today. You do not want to be the last one to understand what is actually happening here. Now, let us go back to January 30th, because the setup for that night matters as much as the crash itself. In the weeks leading up to January 30th, silver had done something extraordinary. The price had gone parabolic in a way most veteran traders had never witnessed in their careers. It screamed into triple-digit territory, a level this market had never seen, and sent real shockwaves through the institutions and banks that have a powerful interest in keeping silver contained. For the first time in a long time, there was genuine fear on the short side of this trade. The entities spending years profiting from suppressed silver prices were looking at a market starting to slip out of their control. And then came January 30th. The timing was not accidental. It never is. The date lined up with Chinese New Year, which meant the Shanghai market was closed. If you do not follow silver closely, you might not immediately understand why that matters. But it matters enormously. Shanghai is where the physical market lives. It is where actual metal changes hands, where buyers who want real, tangible, deliverable silver actually show up to bid. Eastern buyers have been relentlessly pulling physical silver out of Western vaults for years. When Shanghai is open and those buyers are present, there is a natural floor under the price. Real demand from real buyers who want real metal. When Shanghai is closed for a holiday, that floor disappears. The physical bid goes quiet. And in the New York futures market, where paper contracts rather than actual metal drive the price, that absence creates a window of vulnerability. On January 30th, someone walked right through that window. The moment the Eastern session ended and Asian buyers went offline, the futures market came alive. Not with buyers, with sellers. Massive concentrated selling that hit the market with a speed and ferocity that had one clear purpose: drive the price down as hard and as fast as possible, before anyone could react, before natural buying could step in, before the market could find its footing. In less than 60 minutes, silver dropped 17%. By the time the session was over, the total damage had reached 26%, gone in a single night. One of the largest single-session collapses in the history of this market. You heard almost nothing about it from mainstream financial media. Now here is where things get deeply uncomfortable. Most investors, when they hear about a crash that severe, assume that safety systems kicked in and simply were not enough to stop it. They assume the mechanisms designed to prevent this kind of collapse at least tried to do their job. What actually happened is far worse than that. The CME Group, which runs the COMEX Silver Futures Exchange, publicly advertises safety mechanisms called dynamic circuit breakers. The concept is simple. If silver's price moves more than 10% from a rolling reference point, trading is supposed to pause for 2 minutes. A forced halt gives the market time to breathe. Order books refill. Panic selling subsides. Rational pricing gets a chance to reassert itself. It sounds like reasonable protection for investors. It is the kind of mechanism regulators point to when they want to assure the public that these markets are properly supervised. On January 30th, that 2-minute pause never happened, not once. Despite a 17% move in under an hour, the circuit breaker never visibly triggered. There was no halt, there was no pause, no moment where the market stopped and allowed buyers to step back in. The price just kept falling. Stop-loss orders triggered one after another in a cascading chain. Margin calls went out. Retail accounts that people had built up over years got wiped out in real time. And the safety mechanism that everyone was told would prevent exactly this kind of event sat there and appeared to do absolutely nothing. When exchange officials were pressed to explain why the circuit breakers had not engaged, they pointed to something most investors have never heard of: something most financial journalists apparently decided was too complicated to explain to their audiences. It is called velocity logic. And understanding how it actually works is the key to understanding not just January 30th, but virtually every suspicious price crash you have ever watched in silver futures. Drop a comment right now if you have ever watched silver's price collapse suddenly and felt something about it was staged. I genuinely want to know how many of you have had that instinct, because what I am about to explain will confirm exactly why that instinct was right. Velocity logic is an ultra short-term monitoring system that operates at a timescale most human beings cannot even perceive. It watches for price moves within a single millisecond or within a single second. We are talking about a 20-cent move in 1 millisecond or a 60-cent move within 1 second. When the system detects a move that fast, it applies what is called a hidden 5-second hold. Not a visible pause, not a public announcement, a hidden hold that most market participants never even know is happening. But the truly critical piece of what velocity logic does is not the hold itself. It is what happens to the circuit breaker threshold at the exact same moment. When velocity logic triggers, it resets the reference band for the dynamic circuit breaker around the new lower price. Think about what that means in practice. The tripwire that was supposed to catch a 10% fall now starts measuring from the new lower level. The safety threshold moves down with the price, and if the price gets jabbed down again fast enough to trigger velocity logic a second time, the reference band resets again, and then again, and again. This is the mechanism. This is how you crash a market 17% without ever triggering the circuit breaker. Retail investors are told will protect them. You do not take price down in one massive move that would trip the threshold. You take it down in rapid microbursts, each burst fast enough to trigger velocity logic, each one resetting the safety floor to the new lower level, each one pushing the reference point further down until you have reached whatever price target you were aiming for, like picking a lock one tumbler at a time. By the time anyone realizes what has happened, the price is already down 26% and the damage is complete. And here is the part that should make every investor genuinely angry. This mechanism does not benefit ordinary investors. It does not benefit funds that trade silver over weeks or months. It benefits exactly one category of market participant: high-frequency trading firms and large institutions with servers physically located inside the exchange's data centers, with technology capable of executing trades in microseconds, with the resources to use velocity logic as a precision tool rather than being its victim. For everyone else, for the retail investor checking their phone, for the smaller fund without co-located servers, for the physical silver holder watching the paper price get demolished in real time, they are not participants in this process. They are the exit liquidity, the ones whose stop-loss orders get triggered to fill the buy orders of the players who engineered the cascade in the first place. The safety mechanism that was supposed to protect them was designed in a way that allows the most powerful players to neutralize it at will while everyone else has no idea it is even happening. Hit that like button if this is clicking for you. It genuinely helps more people find this kind of honest market analysis when they need it most, and right now a lot of people need it. Now, a reasonable person might ask, if the paper market is this compromised, does it even matter if you hold physical silver rather than futures contracts? The answer is more nuanced than a simple yes or no, and understanding the nuance is what separates investors who navigate this correctly from the ones who do not. If you are a long-term holder of physical silver, the paper price on any given day is noise. Your metal is your metal. It sits in your safe or your vault. It is not a paper claim. It cannot be conjured out of thin air, and it cannot be destroyed by a round of futures selling, regardless of how aggressive or coordinated that selling might be. A 26% paper crash does not change the atomic structure of what you own. It does not change the industrial demand that requires silver to build solar panels or AI infrastructure. It does not change a supply equation that has produced 6 consecutive years of structural deficit. But here is why the paper market still matters even for purely physical investors. The paper price is the signal that most of the world uses to evaluate silver's value. It is the number on financial websites and brokerage platforms. It is what ordinary savers look at when deciding whether to buy. When paper price gets hammered by coordinated futures selling, it discourages real buyers from entering the market. It creates doubt and fear. It makes silver look like a failing investment rather than the supply-constrained, industrially essential, monetarily resurgent asset that it actually is. That is not a side effect of the manipulation. That is one of its primary purposes. And yet, the paper market cannot solve the problem building in the physical world. That problem is severe enough that no amount of futures market maneuvering can resolve it. The Silver Institute, which tracks supply and demand data for this market more comprehensively than virtually any other organization, projects that 2026 will mark the 6th consecutive year where total global silver demand exceeds total global silver production, 6 years in a row. Not a temporary blip. 6 consecutive years of structural deficit where the world is consuming more silver than it is pulling out of the ground. When you run a deficit for 6 years straight, there's only one way to balance the books. You draw down existing inventories. You take metal sitting in storage and put it to work satisfying demand that production cannot meet. That cannot continue indefinitely because inventories are finite. They can only fall so far before the physical market reaches genuine scarcity, and at that point, price has to respond regardless of what the futures market says. The evidence that this drawdown is already well advanced is not subtle. On the COMEX exchange in New York, the silver actually registered and available for delivery against futures contracts has fallen below 100 million ounces. It used to sit above 150 million ounces. It has been declining persistently as metal gets pulled out of exchange vaults and put into real-world use. Shanghai tells an even more dramatic story. China's visible silver stocks held in exchange warehouses have dropped approximately 90% from their 2020 peak. 90%. There have been individual trading sessions where 8% of the entire remaining inventory was withdrawn in a single day. That is not normal inventory management. That is industrial users and investors scrambling to lock in physical metal because they can see the window closing. The silver spot price in Shanghai has been trading at a persistent premium to the Western price. In a properly functioning global market, this should not last more than a brief moment. If you can buy silver cheaper in New York than Shanghai, basic arbitrage says you buy in New York, ship the metal to Shanghai, and pocket the difference. That process should close the gap quickly. But the premium is not closing. It persists because there is not enough physical silver available in the West to satisfy Eastern demand at scale. Western vaults are being drawn down. Eastern buyers are paying whatever premium is necessary to secure what remains. Major financial institutions are now quietly discussing a multi-million ounce imbalance in a market that produces roughly 1 billion ounces per year. Now, it is natural to assume markets self-correct. Prices rise, producers respond, new supply comes online, and the deficit gets closed. That is how oil works, how copper works. Silver has a structural characteristic that makes it fundamentally different from those markets. Somewhere between 70 and 75% of all silver mined globally comes out of the ground as a byproduct. It is extracted from lead mines, zinc mines, copper mines, and gold mines as a secondary output from operations driven by a completely different metal. These mines are not built to produce silver. Silver is just what comes along with it. This means silver supply is not controlled by the silver price. It is controlled by the economics of those other metals. If lead prices fall and a lead mine shuts down, silver production falls with it, even if silver is at an all-time high. If copper demand weakens and copper miners cut production, silver supply drops regardless of what silver is doing. You cannot flip a switch and produce more silver just because it is expensive, because most silver production is not even trying to produce silver in the first place. The primary silver mines that do exist do not represent enough of global output to move the needle when supply needs to increase. And building new primary silver mines from scratch means years of environmental permitting, billions of dollars in capital expenditure, and host governments increasingly inclined toward resource nationalism. This is an inelastic supply, and it is why even at triple-digit silver prices, the structural deficit was projected to continue. On the demand side, two massive forces are converging at exactly the same time, which is what makes the current situation genuinely unprecedented in the history of this market. The first is industrial. Silver is the essential metal for the technologies defining the 21st century economy. Solar energy, artificial intelligence infrastructure, electric vehicles, advanced power electronics. Every one of these sectors depends on silver in ways that cannot be engineered around without real performance cost. Silver has the highest electrical conductivity of any element, higher than copper, higher than gold, higher than anything on the periodic table. In applications where efficiency is paramount, where every fraction of a percent of performance translates into commercial value, silver is not a preference. It is a requirement. Solar panel manufacturers have been trying for years to reduce silver content per panel because it represents a meaningful portion of input costs. They have invested heavily in alternative materials, in thrifting technologies, in anything that would let them deliver the same efficiency with less silver. And yet, silver remains embedded in solar manufacturing at scale because the performance penalty for replacing it is commercially unacceptable in a market where efficiency is everything. The same logic applies to AI and data center build-out. These facilities require massive electrical infrastructure, operating at speeds where nanoseconds matter. Silver outperforms copper in these environments on conductivity, on reliability, on signal quality. When engineers are building the physical backbone of the next generation of artificial intelligence, they choose silver because alternatives genuinely underperform at the margins that matter. The second force is monetary, and this one carries even more profound long-term implications. Silver has a 4,000-year history as real, tangible, nobody else's liability money. That history did not end when modern fiat currency took over. It went dormant while the world experimented with a purely paper monetary system. Now, that experiment is entering a phase that is causing populations and institutions across the globe to remember why hard assets matter. In Asia, accumulation of silver as a monetary asset has been accelerating. India has been buying at record rates. China has been accumulating. Nations that are openly pursuing alternatives to Western financial architecture are increasingly treating physical assets that cannot be printed, inflated, or frozen with a keystroke as foundational elements of the monetary framework they are building. These are not traders looking for a short-term gain. These are nations and hundreds of millions of households making a deliberate decision to hold something real rather than paper promises. In the United States and across the West, the same awakening is happening more gradually. Savers watching purchasing power erode, investors who have seen what happens when financial institutions face stress and the rules get rewritten overnight. These people are rediscovering silver not as a speculative trade, but as the same thing their grandparents understood it to be. Real money with no counterparty risk and no dependence on institutional trust that may or may not be warranted. 3 forces. Inelastic supply from byproduct mining. Surging industrial demand from the technologies of the modern economy. A global monetary reevaluation gathering momentum. These are converging simultaneously right now, not sequentially, all at once, at a moment when exchange inventories are collapsing on both sides of the world and Eastern buyers are paying premiums to secure metal that should not command premiums if supply were adequate. And January 30th did not fix any of this. It did not bring 1 ounce of new silver into existence. It did not reduce industrial demand from solar manufacturers or data center builders. It did not make households in India or China trust their central banks more. It did not close 6 years of structural deficit. All it did was temporarily suppress the paper price in a window when the physical market was closed for a holiday. Leave a comment below and tell me how long you have been following silver and what your biggest frustration with this market has been. I read every single one and genuinely want to know your experience. Here is what I believe is actually happening at the deepest level. The paper silver market and the physical silver market are diverging. They are increasingly pricing 2 separate realities. The paper price reflects the positioning of large institutions, the algorithmic decisions of high-frequency traders, and occasional coordinated selling campaigns using exchange mechanics most investors do not know exist. It is a financial instrument increasingly disconnected from what it is supposed to represent. The physical price reflects what happens when real buyers, with real industrial or monetary needs, try to acquire real metal from a supply chain that is structurally constrained and becoming more so every year. It reflects the premiums Shanghai is paying. It reflects extended delivery timelines at mints. It reflects industrial users scrambling to secure forward supply contracts before availability shrinks further. These 2 prices cannot diverge forever. When paper claims and physical reality are separated by a wide enough margin for long enough, one of 2 things happens. The paper market forces the physical market to capitulate by actually delivering metal at paper prices, or the paper market reprices to reflect physical reality. In a situation of genuine physical scarcity, where the metal required to force physical capitulation simply does not exist in sufficient quantity, history consistently delivers the second outcome. These resolutions do not happen gradually. They do not happen in an orderly, measured way that gives everyone time to adjust. They happen suddenly and at a magnitude that stuns even the people who saw it coming. The price does not drift higher over months. It gaps. It reprices overnight to whatever level is necessary to clear the physical market, regardless of what any paper contract says. No one can tell you when this happens. Anyone claiming to know the timing with certainty is selling you something. The trigger is unknowable. The direction is not. If you are already holding physical silver, understand that daily paper market volatility is noise. Your concern is the long-term structural reality, and that reality is moving in your direction, regardless of January 30th. If you're looking to accumulate, trying to pick the exact bottom of a manipulated correction is close to impossible. What you can do is accumulate methodically, buying incrementally across different price levels with a clear thesis about why you own what you own. Have a plan that does not depend on being right about timing, because timing a manipulated market is not a skill. It is luck with a good story attached. What happened on January 30th was a demonstration of how the largest players in the paper-silver market can execute a coordinated, precisely calibrated takedown using exchange mechanics that most investors do not know exist. It was executed at a moment chosen specifically because the physical buyers who would normally provide a floor were offline for a holiday. It used a mechanism designed so that safety thresholds get systematically reset with each microburst of selling, so that no visible circuit breaker ever fires, so that retail investors watch a quarter of their value disappear in a single night with no protection and no recourse. But it was also, if you read it clearly, a demonstration of desperation, because the players executing that takedown are not operating from a position of strength. They are operating from a position of shrinking options. The physical market is tightening beyond their ability to manage with paper instruments alone. The inventories they have depended on are draining. The Eastern buyers, they tried to push out on January 30th, came back the moment the holiday ended, and kept pulling metal from wherever they could find it. The paper price can create the appearance of a bear market. It cannot create silver. It cannot satisfy demand from solar manufacturers who need it in their panels. It cannot stop data center builders who require it in their infrastructure. It cannot convince Asian households that paper promises are suddenly worth more than metal. It cannot reverse 6 years of structural deficit with a futures selling campaign executed on a night when the physical market is closed. What it can do is create opportunity for people who understand what is actually happening. Every paper crash, not driven by deteriorating physical fundamentals, is, for the patient accumulator who is not overleveraged and not dependent on short-term price performance, a chance to acquire more of an asset whose structural case has not changed. January 30th was a night when people who understood this market clearly could watch a 26% paper crash without panic because they knew what it did and did not change. What it did not change is the supply deficit. What it did not change is the industrial demand trajectory. And what it did not change is Eastern monetary accumulation. And what it did not change is the direction of exchange inventories on both sides of the world. What changed was a number on a screen. And in a market where that number is increasingly disconnected from the physical reality of a structurally constrained essential commodity, that number on any given night is the least reliable piece of information available to you. Subscribe to Element Axis and turn on notifications because the situation in this market is moving faster than most people realize, and the next significant development could come with very little warning. This story is far from over. By almost every measure that matters in the physical world, it is just getting started. The people paying close attention right now, building a real framework for understanding what is happening, rather than accepting the mainstream narrative, those are the people who will be properly positioned when the paper, fiction, and physical reality finally meet. Make sure you are one of them,